Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm having a conversation with Roy Keenan from Yarra Capital Management. Roy is going to be talking to us about the risks and opportunities he's seeing in the fixed income market. Roy, it's great to see you as always.
Hey Chris, it's always good to have a chat with you, mate.
Now Roy, let's take our minds back to this time last year, February 2025. You and I did a podcast together, and when I asked you about the most important thing that was going on in markets at that particular moment, you said Trump, and that he was being underestimated by everyone. So you've proven to be correct. What's your assessment of how things have unfolded, and then maybe what are some of the most important factors as we sit here today?
Look, I think, it's nice to be right every now and then, so I'll take that. But look, I think, that when I was talking about that, we were talking about how we're going to position for the market and that upcoming tariff announcement in April. And in some ways it was probably pretty easy to sort of, to look at that. But then how do you navigate through that? And I think, for us, the pleasing thing was we positioned ourselves for that. We navigated it, got right, and that set us up for the rest of the year. So, I think that's probably, the awesome part of it. But when I think about where we are today and is it still Trump? I'd say in some ways, yes. But in some ways, I think the markets Trump had just come in when we probably last spoke in that podcast. And today the market is sort of so used to what Trump's doing. And, let's face it, over Christmas, New Year and Venezuela and so much going on that, the market's almost predicting, well, if this happens, what's his next move? And we've only just recently seen that over the weekend with the court, finding against the tariffs, Trump's tariffs. So, but the market reaction was pretty muted in some ways, and it's because the market's already thinking about, well, what's his next step, right? So I think in some ways it is still Trump but it's the unknown of what Trump can do. If it's something that the market's already pricing or looking at, I don't think his impact was probably big as what we were at the start of last year. I think the other thing that I'm thinking about is the RBA. I think that's something domestically that from Yarra's point of view, we didn't think they needed to tighten, to curb inflation and slow down, and basically, get the supply and demand balance back into equilibrium. And I sort of when I think about yes, we were wrong in thinking they didn't need to tighten, but I think there's that introduced risks that if the RBA is calling the market the way they is, what's that implications for investing? But what happens if they're wrong? And we're sort of sitting there thinking about, well, where we sit today, where are those opportunities? And time will tell whether the RBA is jumping at shadows and they tighten too early. And does that mean that they should be looking at cutting later in the year? So that's some of the things that we're sort of thinking about. And I think probably the other thing that we can't ignore is AI and software, right? Mm-hmm. I mean, I think you don't go a day where, at the moment where the American market's sort of up and down and moving. And, in some ways, from my point of view, Australia's a bit immune from, the noise in sort of direct investment point of view. We don't have a lot of exposure to AI or software companies in where we invest. But it doesn't mean you can't ignore it, because if the market's looking at it and it's affecting equity valuations, affecting credit markets because some of these companies have a large amount of debt, what does that do to reprice risk? And that ultimately affects us, right? Even if we're not directly exposed. So you've got to, I think every investor's got to watch how that's playing out, because it started to gain momentum and attract a lot more interest.
Well, I just want to pull on the RBA thread, because I think it will be very valuable for our readers. So is it in Yarra's expectation that this could be a one-shot deal? The RBA is notorious for going twice to try and kill something or to move something. So now that they have done the first one, I guess, what is the expectation? What does Tim think? What do you guys collectively think might be the next move?
Look, I think in some ways, as I said, we were wrong because we thought they shouldn't be tightening. It doesn't mean we're wrong, but it just means that we got it wrong in the sense that they did.
Yep.
They did move. So, look, I think for us for me particularly as an investor, first I'll start with the house view. The house view is that the next move's a cut later in the year, right? So
Right.
he thinks it's a one-off, right? Tim does.
Mhm.
So, which is probably natural given his starting position and our starting position. I think as an investor, though, for myself, the market's already pricing in the second one and a bit
Yeah.
more, right? I'm not as fearful of, what's that ramifications if they do tighten because the market's already there. The
Yep.
opportunity is what if they don't tighten?
Right.
Then that's where the opportunity to actually add value to the funds that you invest. So from my point of view, that's how I'm seeing that. And in some ways, trying to set the portfolio without not taking too much risk to maximize from those those potential opportunities.
Let's shift focus a little bit, Roy. You've talked about investors moving away from US dollar denominated assets and the Aussie credit market benefiting from that move. So just talk to me about how that unfolded and how you and Yarra have been taking advantage of it.
Yeah, look, I think we identified this probably 12 months ago. I'll say Tim and our house view was, that basically we got that wrong on the RBA. But the one thing we did get right is our view on the currency, where most people had the currency going down. We thought it was very undervalued. And unlike the RBA, who think it's been mainly the tightening cycle that they've started to implement that's been pushing the Aussie dollar up, we think there was a lot more other reasons for that. But if I move and focus on what does it mean for the markets, it's been the making of fixed income markets. I know in my career today, if I sit back and look at it and I go, I think it's the best shape I've seen fixed income, and particularly credit markets, in my time. And what do I mean by that? There's more players in the market. There's more liquidity. Issuers can get more tenure, which means investors can as well if they want to take that route. I think from a point of view of this has come about because of that US dollar weakness that we've started to see, but also I suppose in some ways people looking at the US and going, they're not really comfortable with the politics there and the geopolitical climate and President Trump. Where's a safe place to invest, and what looks attractive? And I think Australia was just naturally in a very good position. And I think that geopolitically we look good. We've got a stable government, and our currency was cheap. So if you're getting good returns versus the risk in what you're switching out of, in the case of say USIG versus Aussie IG, why wouldn't you do that move? And we've seen that happen in. We're seeing that happen in droves because Asian investors in primary deals that we're seeing have gone from those sort of low teens to now 35-45% of primary deals. So whilst it's competitive for us as a domestic fund manager, it creates a lot more opportunities for diversification and other things that mind you, the other side of that comes with extra work because we get more issuers, new names. We've actually had to put an extra credit analyst to cover the credit. So it's pretty exciting. It really is. And I think for 2026, that trend continues. I don't think, everyone talks about, we're not talking about investors switching completely out of the US dollar and moving into other currencies. We're talking about small, moves in percentage terms, which just happen to be big numbers from an Aussie dollar perspective. And, our market now, from a credit point of view, we're now the fourth largest issuer in the world behind the euro and predominantly US dollar issuance. So that's exciting for us as a fixed income investor.
Roy, you talked there about the geopolitical risks in the US. I just wanted to ask about the US debt pile as well. It seems unlikely that the US will ever default on its debt, at least in our lifetimes. But is that something that has investors worried and sees them steering away from that opportunity?
I think you only have to look at the term premium that's built into, the US bond rate at the moment, and it has been increasing over time. I think that tells you everything.
Yeah.
The risk, in US, I don't think in my lifetime in bond markets will probably, the US will lose their risk-free status. But,
Yep.
I think that, moments like what we've seen with President Trump's policies is that, he's essentially been raising all this great income, but actually has been giving it back in tax cuts and other means and not repaying debt, right? So that sort of fiscal cliff that we always talk about, is getting closer and closer, right? So that's problem. I think that's problematic for bond markets. In some ways, short-term interest rates globally, the yield curves have been flattening, and I just think that that trend at some point might switch because the reality is that fiscal cliff and that fiscal burden that we're starting to see the US develop, probably means that interest rates are going to remain higher for longer. And despite the Fed being forecast to cut 2 or 3 times in 2026, it's hard to imagine how longer term bonds can rally too far. So hence I sort of think over time, if you sort of look on a 1 to 2 year view, yield curves probably steepen off the back of that, which will be an opportunity. And in some ways, we're sort of trying to avoid the long end of the yield curve in our investing. Not so much from a credit point of view, but from more of an interest rate outlook, because I think that's the hardest part of the yield curve to call at the moment.
Roy, there's been some talk from certain parts of the market that the old 60-40 portfolio is dead. The point being that bonds are no longer defensive and the correlation with equities, especially post 2022, remains stronger than people would like it to be. What would you say to that idea?
First of all, I'm not an asset allocator, so I'm not going to give that advice. If I was an asset allocator, I'd have a portfolio 100% in bonds, right? So look, I think that discussion about bonds and losing their defensiveness, I think goes back to the point of when rates were zero, bonds didn't have their defensiveness, right? And whether it's government bonds or semi-governments or even moving into credit, the outright yields that were available at that point in time just weren't that attractive, and we're never going to give it that defensiveness. I think that argument's gone a lot today. I think that when you have a 10-year bond close to 4.8% that we have today, and if you're investing in a major bank tier 2 for whether it be 10 or 15 years and getting a 6.5 type return, that's pretty attractive, and in some ways that's the defensiveness side coming back into it. So I think you only have to look back, and I mentioned at the start about April. That was a very good example of how bonds had their defensiveness. I know from our funds perspective, in our credit funds, we had interest rate duration going into that period a bit longer. Despite the fact that it was a risk-off event, credit spreads blew out. Because we had that sort of defensiveness in there with our duration, we had positive returns for the month. So I would argue that people who say that bonds have lost their defensiveness, it's not true. Markets tend to be correlated for a period of time, but if you do get severe events like that, that's when bonds come back to the fore.
Roy, let's talk about private credit. I'm just going to, for the sake of the audience, share a quote from an interview that you did with Money Management. So you said, when you grow so quickly, of course, referring to the private credit space, then that money needs to get put to work. If there is too much money in a sector, then credit spreads come in and potentially come in too tight to the point where you're not getting paid for the risk that you are taking. So that's something that you always talk to me about, making sure that you get paid for the risk that you're taking. So that sort of all makes sense. But then you went on to say the gap between investment grade credit and private credit is probably going to narrow over time. So investors just need to be aware of that and aware of the risks. So I just wanted to hone in specifically on what they need to be aware of and the risks, and how does it compare to the investments that you're making in your portfolios?
What I was referring to there is that private credit's a big market, so I don't want to pick on just private credit in totality. There's segments of private credit, right? And in some ways, this goes back to the APRA announcement on AT1, over a year ago. People have actually started to fund managers have created a product for investors to sort of solve for that lack of issuance of AT1 paper, and good on them, right? But what it's done is that a lot of the product that has been created essentially has raised significant amounts of money. And some of those products are raised of promising fixed type returns, right? So, so what happens with that is when you raise such a large amount of money in a short period of time, it has to find a home, right? Because you've raised the money and you have to invest it to get the return that you're promising. And I think when I made that comment, I was thinking about like, what does that mean for some of those segments of the private credit market? Because what happens is those markets aren't deep and large markets, right? So there's a reason why they offer attractive returns, because they're harder to access, and they're in some cases illiquid, right? So what's naturally happened, and we've seen this take place over the last 6 months, is as money's deployed, the actual spreads have started to come in. And you've got to remember, in those products, you get compensated in private credit for credit risk, but also for illiquidity risk. And when I made those comments versus IG, we've seen sub-segments of the market where the compression has happened. And, we're talking sort of 100, 200 basis points sort of compression in sub-segments of the market. Now, there's some segments of the private credit market that still look attractive because money's not being deployed there, right? So us as a manager, when we look across, especially our sort of multi-sector credit funds, we want to get paid for that risk, as I mentioned at the start. So what we're doing at the moment is we're avoiding some segments of the marketplace because we're not getting paid for that risk, and particularly not getting paid for that illiquidity premium. So we go looking elsewhere to try and find where we are getting paid for that illiquidity premium.
So Roy, just to, again, to pull on that thread, so when you say you're not getting paid for that specific risk, as it means you're not getting compensated enough for a risk that you don't want to take? Is it more about the return, or is it more about the risk, I guess is what I'm asking?
You assess the risk and you're not getting paid enough return for the risk.
Got you.
It doesn't mean that you think that it's going to be a bad investment. Far from it. It just means when you look at the universe and you go, well, for that level of risk, can I find better returns elsewhere?
Yeah, that's a very important clarification, and thank you for sharing it.
Yeah, and I think that's the key thing, right? We're not saying it's a bad investment. We're just saying we can find better returns elsewhere where we're going to get paid for that illiquidity premium.
Yeah, and I think oftentimes that's the thing that investors forget across many asset classes, is they just look at the potential return and they don't understand the risk that has to be taken to generate that return. And maybe if they understood that, they'd be less comfortable with the return number. So, no, I appreciate you sharing that insight.
Look, I would say also that there's a lot of noise in the US at the moment around software companies and private credit and vice versa. And as we've seen, over the last couple of years, those sectors have had big inflows. The thing is, once we get into an outflow mode in some segments of the market, the asset managers have to sell the assets. Now, if they're illiquid, they obviously have to sell at a discount, or and some have been achieving selling out at good market value, right? So, but that's one of the key risks that you look at the market going forward, is that if the market goes into a prolonged period of outflow, how do managers handle that? And more importantly, how do they dispose of the assets?
Yeah, everyone rushing for the exits at the same time is never a good thing generally, is it? Yeah. Let's talk about what you are liking at the moment, Roy. So how have you set up the portfolios, and what are you trying to capture across quality, duration, and all of those elements that go into the portfolio normally?
Yeah, look, I'd start by saying it's been a busy start to the year. I think we've participated in 11 out of about 15, 16 primary deals, which is already, we're sort of in February now, and, we've got another month to go to the quarter, which is always, which has already beaten the last quarter of last year we've participated. So there's ample of opportunity out there for us. I'm a bit of a calendar guy. When I turn to calendar on the 1st of July, what's the next 12 months look like? What's really interesting is when I looked at the start of this year versus the start of last year, I would say to you that, in the segment that I concentrate in, the yield opportunity was exactly the same. Right. And it was quite odd because credit spreads have come in. But what we've had is, to offset credit spreads coming in, we've had obviously with the RBA expectation, the actual underlying, base rate or the yield has been rising, right? So you ought to almost start at the same point in the cycles we year before. So, which was obviously a positive year for us as well. So I sort of looked at that and go, well, at the start of the year, where's the risk in my portfolio? And we just felt that with the spreads contracting so much, we started the sort of January period by selling a lot of our major bank tier two, mainly longer dated, exposures, which we call 15 non-call 10, so literally 10-year exposure. And we decided to move out of that and probably what we would call rotate down the sort of credit curve. We might give up a little bit in credit spread, but we're de-risking the portfolio a lot there. And also then concentrating on moving into some of the assets or new issues where we would, by doing that, we could also pick up a bit of extra yield. And I think picking up a bit of extra yield, if it's quality yield into this environment, is probably the way to go. The other thing we focused on, which gets back to what I was talking about the RBA earlier, I was trying to buy a lot of, particularly the first point at the start of the year where we sort of had probably 2.5 tightenings built into the interest rate curve, buying quality fixed rates 2 to 3 year tier 2 paper from major banks, which were coming with a 5% handle on it. I just thought risk reward above cash, that made a lot of sense. And if we're right, and there's only one tightening, and those sort of front end securities perform very well. So that's sort of where we've sort of invested, and what we're trying to set up. But I think we're just, we're getting towards the back end of the reporting season now, and it's been it's been pretty volatile for equities, but I think that's more equity valuation. From a credit point of view, touch wood, thus far, it's been a very good reporting period for credit.
So, Roy, I was going to ask you, the next question was literally around tier 2 bank paper, because you and I have discussed it quite a lot in the past, but it seems like you've sold some of the longer dated stuff and bought some of the shorter dated stuff. Is that a fair assessment?
Yes, that's correct. Yeah. And it's not that I dislike it. It was just more, some of the credit spreads in that part of the market have probably rallied around 50 basis points in the last 12 months. Right. And we've done extremely well out of it, and done extremely well with our hedging policy. So it just made sense for us to sort of de-risk from that. It's definitely nothing against, because you look at that opportunity and the outright yield is still quite attractive. But I'd rather have my outright yield, bets in that fronter end of the curve than out in the longer end of the turn. As I spoke earlier, I think picking longer term rates at the moment, especially what's going on in the US, I think you'll get better opportunities to sort of expose your fund to the back end of the yield curve into the future. But that being said, look, the retail, and I forgot to mention this earlier, the retail market, the boomers are definitely moving from wealth creation into income creation. They're having a big impact on the market, and particularly in 10-year bank major tier 2, where you can get a sort of 6+ handle for a yield for a major bank tier 2 paper, which is A1 rated, high quality. If I was sitting back as a retail investor, it looks pretty attractive. So I sort of can get why that's happening, but I'm sort of looking at probably different parts of the curve, different parts of the credit market, and I see opportunities elsewhere.
Roy, can you talk to me about, I think you said you'd participated in 11 of 16 opportunities, new issuance in the last month or since the start of January. Talk to me about a couple of those trades and why they stood out.
We invested in a bank senior corporate paper from a company called Aroundtown, which is a German REIT. Quite an attractive yield. They issued a 10-year and 5-year security. We were very happy to invest there. We'd covered that, that German REIT. We'd basically covered back when they last had an issue in Australia. It was a very good buy for us. We had a very good experience with it. They have had some issues in the past, but that seems to be behind them now. It's traded very well. We've bought some AusNet corporate paper, which once again was a very good investment. I think that AusNet corporate paper has almost taken corporate hybrid issuance to about $12 billion since the APRA announcement of the seizure of AT1, and that's a segment of the market that's growing rapidly, which is pretty exciting for us because the more we get different issuers, different opportunities, our investment universe is growing. So while it was very disappointing for APRA to cease the issuance of AT1, it's created this whole new segment of the market, which is providing even more opportunities for funds like what we do at Yarra.
Roy, last one. Message for those thinking about fixed income into 2026. Sounds like you're looking at it glass half full.
From my perspective, bottom up, credit looks really good. Australian companies are in really good shape. Yes, credit spreads are sort of getting to long-term averages or slightly below, but I think you just have to look at the total return aspect of it, and the yield opportunity, in my view, looks pretty compelling. And I reckon the biggest risk against that is a major move down in equities. Where you'd get people starting to allocate away from equities into fixed, out of fixed income into equities.
Using fixed income as a funding source. Is that what you mean?
Absolutely. Yep. Yeah. And that's because equities will just look, I'm talking massive 20, 30% fall down in equities. But I think apart from that, you look at the risk reward opportunity, picking, as I mentioned earlier, picking up a 6% handle, investment grade credit, which is where our funds are at the moment. It's pretty compelling. And if we do everything right, there's no reason why you can't see returns in the 12 months to 31 December being higher than that. So, I'm pretty excited. It's as I said, it's probably the best I've seen market. So, when I say it's the best I've seen markets, it means it's providing a lot of opportunities for us as well. So, so that's the good thing. So, I think it's a good time to be involved in fixed income.
Roy, it's always a pleasure, mate. Thank you so much for having a chat and taking us through how you're seeing the market at the moment. Very insightful as always.
It's always great to chat, Chris. Thank you.
If you enjoyed that interview, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.